Hi friends, very good evening. In today's video, I'll be briefly talking about bank fixed deposits versus debt mutual funds in the Indian context. Just a comparison. Okay, so firstly, let's understand bank fixed deposits in India are covered under an insurance scheme where the money up to 5 lakh rupees in the form of deposits is protected. So that means the principal and the interest is protected. Now, what type of banks are covered? So I just took a small detailing on that. So banks which are covered are commercial banks, all commercial banks, and all cooperative banks. So money up to 5 lakh rupees for an investor is protected. So this is one very good thing. And what type of deposits? It could include saving, fixed deposit, current, recurring deposit, etc. All type of deposits which I mentioned just now are covered under this. Now coming to debt mutual funds. Debt mutual funds invest into debt assets. Now what are these debt assets? It could mean bonds, it could mean any kind of securities, etc. Various kind of debt papers, short term, medium term, money market things. So that is there. Now there is no kind of guarantee there for anything which protection is there in the case of bank fixed deposits. This is one key difference or comparison. Now, coming to other pointers which I have read and I thought I'll just share with you briefly. So, the other comparison is in terms of there is some kind of clarity in terms of returns, which is there in the case, or almost a large amount of clarity that, of course, okay, you will get this percentage in terms of returns in case of bank fixed deposit, which is not the case of debt mutual funds because the returns keep varying depending upon how these paper would perform on a daily basis, but the NAV keeps changing. Okay. Now, obviously, I've just shared with you the risks associated between the two instruments because there is some guarantee in there in the bank FD versus which is not the case in the case of debt mutual funds. Apart from this, debt mutual funds also carry three kinds of risk. One is the credit risk, that means the kind of papers they invest, the interest rate risk, and the liquidity risk. That means how mature, how liquid the paper are to sell tomorrow if somebody were to sell, how quickly you could sell. Okay. Now, in terms of overall, let's say I want to get my money back, the overall liquidity situation, both debt mutual funds and bank FDs are very liquid. So you can get your money very quickly in both. Now, obviously, uh, there are a lot many schemes available in bank fixed deposit. New things are there, quite flexible. So that is there, which is also the case in case of debt mutual funds. So that kind of flexibility is also there. Okay. In terms of taxation, the earlier advantage which used to be there, where bank FDs were slightly inefficient and debt mutual funds were more efficient, that is gone. Now everything is taxed as per the slab of the individual, as per the current laws. Okay. Now coming to the final point is that, so what is the clear winner? Of course, there are no clear winners. Everything is now, you can't differentiate. I've just shared that every certain thing has their own pros, certain thing has own cons. So that is the final thing which I feel is the conclusion in right now. Okay, thank you very much, and I hope you like this video. Now coming to the disclaimer, please note that this is a free educational video purely for the purpose of learning. This should in no manner be considered as any kind of advice, offer or promotion to sell anything. Information is purely for viewer or investor education. You need to do your own due diligence. I will not be responsible for the accuracy of the facts stated or also be responsible for any kind of financial loss on account of viewing this video. You need to do your own discretion, consult your own financial experts. Viewers need to do that. Thank you very much, and I hope you like this video. Take care.